Welcome everyone to FX Street. It's 8:30 a.m. Eastern. Today is Tuesday, August 28th, 2012. Welcome back one and all. Great that you could join us. My name is Adam Rosen. Very happy to be here today. What we're going to talk about today are charts. Lately we've been focusing a lot on technical and on fundamental analysis and the reasons why the Forex market moves. Today we're going to apply our expertise to the charts to try to identify the market condition and very simply find the best trade setups. Now there's probably thousands of hours, if not thousands of days we could commit to the subject. So what I would say is that today what we're going to talk about is just one approach of many. And that if you have an approach that works, if you have a technical analysis regimen that works, stick with it. If you have any kind of regimen that works in the market, if it's making money, don't change. But what we hope to do is maybe open everyone's eyes to maybe a little bit of a different idea. Now we're going to try to keep things simple, stick to the daily charts. I always like to start with the daily charts because it offers a nice compromise between the long-term trend and the short-term movements. And we could use weekly charts and monthly charts as well, but sometimes that tends to, sort of not highlight the intricacies that occur every single day. So we start with a daily chart. I like to go back about 6 months or so. These charts go back to around February, more or less. Now, there's two different basic approaches that I use in terms of technical analysis. And I'll chat in some notes here, and now just to keep things orderly. Technical analysis, I like to use trend lines, which include diagonal, horizontal, and Fibonacci. Okay? To draw the trend lines, we very simply draw a downtrending resistance. Now, if the market is trending to the downside, in fact, before I get further, get ahead of myself here, if we look at the chart and the chart has made significant progress to the downside over the past 6 months, obviously it's a downtrend. If it was going up, there would be an uptrend. In a downtrend, resistance is most important. Resistance is the upper line because what we want to do is draw our downtrending resistance connecting significant highs. It's a little bit of an art, a little bit of a science. It's true we could draw a resistance line as follows, but two things. First of all, that data that has not been seen in quite a long time. The last time the market touches resistance line was May of this year, so it's not very relevant. Second of all, the market right now is not very close to that resistance line, so it really doesn't help us out at all. This resistance line is much more relevant because we've touched this data points. We have to touch it at least twice. Once, April 30th. The second time was August 23rd, just a few days ago. So it still is very relevant. Now, resistance is important in a downtrending market because it's going to tell us where to sell short. We want to sell short as close as possible to resistance at a point where we believe the market can touch, which is right underneath resistance, which is, for all intents and purposes, right over here. Protective stops should be placed above resistance at a point where we expect the market will not test or will not trade to, and that is just above resistance. We'll make that line red. And that's about it in terms of plotting our entry points according to our downtrending resistance. We draw a support level, and if we can find a support level that falls in a parallel fashion to resistance, that's great. That's an extra source of confirmation. In this case, it may not be possible. I'd say about 50% of the time it is possible. We can always experiment with different downtrending resistance lines to see if we find another line that does project its support level. This actually does fall in a parallel fashion, this long-term downtrending resistance line. Okay. Support, by the way, is where we project to take our profits or where at least the market could trade. What we also do is draw trend lines to connect significant highs and significant lows. Significant highs and significant lows. What was once former resistance could become new support once we break below. What was former resistance could become new support. Take a look at over here. This level that the market held for quite a while, and I know it did cross below this line. This line, by the way, is around 124. 124.38, 124.40 roughly. We did cross below this line, but then it held a few candlesticks, actually a few weeks in a row, actually about a month or so. The market, the euro dollar, failed to break below 123.38. And by the way, if we can draw a horizontal line that comes very close to the large round figures I consider every 50 pips. 124, 124.50, 125, 125.50, etc. If you can find a resistance or support level that comes as close as possible to one of these large round figures, that's all the better. Here's a line that I adjusted to 124.50. Doesn't have to be exact. Rarely will it touch exactly that large round figure. But if it comes pretty close, within about 10 pips or so, I say that's a good sign. Now notice 124.50, that at this point, we're talking about June of this year, did act as support. We then eventually broke below it. Now, once we broke below it, I'm thinking this 124.50, it was support, it could be new resistance. Well, the fact of the matter is we came up to 124.42 within 8 pips of our former supports, new resistance, and if we decide to sell short at 124.42, the market ended up coming down to 122.40, came down about 200 pips. Not too bad. Eventually we did break to the upside, but I'm sure we can envision how if we sold short and the market then went down 200 pips, we would either have taken profit, moved our stops to break even, or maybe a combination of both. The market then eventually crossed above 124.50, so we have to look to a higher resistance level. A higher resistance level can be inside this channel as well to connect significant highs and significant lows. Take a look at over here. We connected the highs of May 21st to the highs of June 20th, about a month span, and that acted as new resistance. We did not know this downtrending long-term resistance would emerge. Actually, no, we did not know that was going to be the case yet. But we were able to determine that, well, with an educated guess, the market might stop and reverse here. Now we have a point where quite a few different resistance lines are crossing at the same point. We have 124.50, that's a little below us. We have this downtrending, I would call this an intermediate resistance line, a downtrending long-term resistance line. Very impressive that the market, once we have a couple of different projected resistance lines cross at approximately the same point, this is a very important point for me, because we have a number of different lines that cross at the same point. Question, how about an ascending channel, the trend line connecting the recent bottoms of the euro? It's a great point. We can look at the market, we can then zoom in and look at the market from the downside looking up, because it is true. Within every trend there is a range, and with every range there's a trend, and within every downtrend there's a smaller term range. Going back to the long-term view that we were just looking at, let's take this line away. Going back to this view, we know the market is clearly going down. With that said, once we've determined, okay, this is a downtrending resistance, we can then zoom in. Again, we're still on a daily chart. We can then move to the upside and say, okay, well, I can draw an uptrending support level. Let's make this a little bit different just to kind of keep track of everything here. We'll make this a dotted line, okay, to differentiate. We do have a smaller uptrending channel within a long-term trend to the downside. But it is very important, let's try to bring this line to make it, look, you see what I'm doing? I'm trying to find two lines that fall in the most parallel fashion. Parallel lines are an extra source of confirmation, which is very important. Now, this is true, and this is accurate. This uptrending channel does exist within a long-term downtrending channel. But the fact that this is this shorter-term channel, I mean, we're still on a daily chart, but it is measuring a shorter amount of time. We're only going back to late July over here versus this long-term chart that goes back to February of this year. The longer the time frame, the more dominant the trend. Going back to February this year, literally almost the entire year, buyers and sellers have met and have agreed that the euro dollar should go lower. Over the past month or so, buyers and sellers have met and said, okay, well, the euro dollar should go higher. But that does not take away, does not negate what has happened over the past 7 months or so. So the fact that this long-term, this short-term, let's say it again, the fact that this intermediate-term trend is going to the upside contradicts the long-term trend to the downside, that is a very important piece of information that I'm going to use in planning my trade. Very specifically, I will not place a long-term trade against the long-term trend. Let me type that in. I will not place a long-term trade that contradicts, I think that's how you spell it, contradicts the long-term trend. The trend is your friend. Long-term trades, just to be clear, long-term trades equal large stops, large limits, holding the trade for a long period of time. Okay. A long-term trade, I might use a 200 pip stop, I might not use any limit order, and I might hold on to the trade for 6 months. And the easiest way we can kind of visualize what a trade is trying to accomplish here, ask yourself the question. For a long-term trade, let's say we use a 100 pip stop and a 300 pip limit. That's a long-term trade. Or let's make it easy. Let's say a 100 pip stop and a 100 pip limit. What is the probability that the market is going to go up 100 pips from this point or go down 100 pips from this point? We look at the euro-dollar chart right now. We're at intermediate resistance points. What is the probability that euro-dollar is going to go up 100 or down 100? I would say, 65% chance. I'm making up the numbers. Let's say 65% chance that the euro-dollar will go down 100 pips before it'll go up 100 pips. A short-term trade, day trade, equals small stops, limits, short period of time. Short-term trade, day trade, it could be 10 or 20 pips. 10 or 20 pips stop and limits. Well, to answer the next question, by the way, our long-term trend is based on weekly or daily. Oh, okay, it's based on daily charts. I always like to start with the daily charts. Now, on top of that, we can then move to a 4-hour chart or a 1-hour chart. And we can draw the trend lines in the same fashion. I'm not going to do it here because these lines are all of a sudden going to get very confusing. But we can continue to whittle down on the time frame to look for smaller time frames, to look for maybe a day trade. And a day trade might tell us, hey, we're in a short-term support level. In fact, let me do it this way. Daily charts, zoom in. Let's say we come down to this uptrending support level, which is at 123.80. What kind of trade would be appropriate here? A counter trend trade might make sense. Because a counter trend trade, it may go against the long-term trade, but we should be aware of the extra risk. And make no mistake, there is extra risk. We can wait for the market to come down to its uptrending support level. We're still in the daily charts. In this case, I would suggest that maybe a counter trend trade would be more appropriate, because now we're asking ourselves the question of the support line. What is the probability the market goes up 20 pips before it goes down 20 pips? I would say probability is probably 65% it goes up 20 pips versus down 20 pips. But buying the euro dollar is, make no mistake, it is fighting the long-term trend. So it does take on extra risk. So short-term trades, I would say, are the only kind of trades I would take counter trend. Long-term trades are more appropriate when we're trading with the trend. If I had to pick between the two, I definitely prefer to take long-term trades. Because the long-term trades, first of all, it's a lot easier, okay? It's a lot easier to make 100 pips or risk 100 pips versus 10 pips or 10 pips. If we're trading with a 10 pip stop and a 10 pip limit, we have to be almost exactly right with our entries. For those of you that have day traded before, I'm sure that you'll agree with me. It's really tough to pick a spot on the chart and to say the market's not going to go any further than 10 pips. 10 pips is nothing. It's 1/10 of a penny. I mean, if we could find a stock and we could say, forget 10 pips. Let's say buy a stock like Apple Computer that averages, $12 a day and buy it with a 10-cent stop. You're going to get stopped out all day long. To buy a Forex currency pair with a 100 pip stop, we have a much better chance of being right. And I can tell you from my own personal experience, and I used to be a full-time day trader in the stock market. I now prefer to long-term trade. I get stopped out a lot less in long-term trading the Forex markets. If you had to pick 3 stocks that you think are going to be higher than they are now in the next 10 years, that's pretty easy. Facebook, Apple, Microsoft. If you had to pick 3 stocks that are going to be up between 9:30 a.m. Eastern and 9:35 when the stock market opens in the U.S., that's very difficult. I have no idea. I mean, the incremental buying and selling pressure, that's so unbelievably difficult to predict. The long-term trends, the long-term fundamentals are a lot more clear. Which stock has a better chance of doing well over the long term, Apple or Samsung? Well, they're involved in a lawsuit. It looks like Samsung's losing the lawsuit. I'd say Apple has a better chance of outperforming Samsung over the long term. When trading a standard lot, 10 pips equals $100. It's a great point. That means we have to adjust the risk. We have to adjust the position size. The position size always has to be adjusted to suit the stop distance, not the other way around. Position size should be the last decision that we make. Generally speaking, max risk per position, no, I'm getting off subject here, equals 5% of our current account equity. So if we have a $2,000 account, 5% equals $100. 5% is huge, by the way, you're right. 5% should be your maximum. I'm talking about home run type of ideas. This thing, I have never seen something look so good. $100 equals 100 pips. 100 pips times 1 mini lot. Mini lots, which is 10K, by the way, just to give you a little idea. So in other words, we're trading 1 mini lot for every $2,000 of equity in our account if we're really maxing out the position size. Now, you can start with half of that. We can, the great thing is with all these Forex brokers, we can, we don't have to trade a mini lot. We can trade a half a mini lot or a micro lot or whatever position size we like. But if you have $2,000 in your account, and I want to sell short the euro dollar, but maybe I'm not so confident, or I know I'm going to want to add to it. We can always stack our positions, sell short a little bit here and add to the trade a little bit later on with a better price, get a dollar cost average type of situation going. We can do so, but start with half a mini lot, 100 pip stop. Add another half of a mini lot with another 100 pip stop. We can stagger out our entries and exits. For long-term trades, I generally use a 100 pip stop. 100 pip stop or 1 daily ATR. Okay? ATR, insert the indicator, average true range. Average true range basically counts the distance of the candlesticks from top to bottom on a daily chart. You just take a look at where the level is right now, which is 0.0081. Euro dollar, 1 daily chart ATR equals 0.0081, which equals 81 pips. You just read this just like you would read the quote on the chart. 81 pips plus or minus the current quote on the euro dollar. The beauty with the ATR is that when the market gets more volatile, the ATR will increase. And it'll allow us to use bigger stops, which we should use when the market's more volatile. Apple Computer trades has a $12, I don't know what it is, but it had 12, it was up $12 yesterday. We don't want to use a $1 stop on Apple Computer. We might want to use a 1 daily ATR, which could be $12. Microsoft might have an ATR of, $2 a day. So we would use a smaller stop. The ATR is also good for our limits as well. So if we use 81 pips for our stop, we might want to use a 3-to-1 risk-reward ratio, where our limit's 3 times as big as our stop. So 3 times 81 is 243, right? 243. Again, as the market gets more volatile, we use bigger stops, and we'll anticipate to use bigger limit orders as well. ATR is a really helpful indicator if you're going to use, if we should always use stops. But if you want to use a dynamic stop and limit, that's going to understand or take into consideration the volatility of the market, use the ATR. Average true range. Okay. So now with trend lines, I think we've done a pretty good job ad nauseum at discussing our resistance lines, support lines, determining which way the market's going to go, and using horizontal lines as well as diagonal lines, trying to anticipate where the market could find new support or resistance. If we draw a trend line and that trend line is subsequently broken as it is here, then we obviously have to disregard that as a possible resistance. But please be aware, what was former resistance could become new support and the other way around. Now, I'm going to take away all these lines and I'm going to throw in a different indicator, actually a few different indicators. The beauty is with MT4 MetaTrader charts, and you can do this with a lot of other charts too, you can create a template and save it, which is what I've done. Now, where did my templates go? Oh, sorry. Right-click, templates. Now, I call this the moving averages and Bollinger Band templates. I like to use 3 different moving averages. The specific moving averages that we use are not important, but make sure once you determine which moving average to use, then use those moving averages consistently, just to keep everything on a level playing field. We can use simple moving averages or exponential moving averages or a variation of other moving averages. There's a lot of them, actually. I use simple moving averages, no other reason, just out of habit. Again, if you start with simple moving averages, continue. There's not one that's better than the other. The difference between simple and exponential moving averages, by the way, is simple moving averages, a 20 simple moving average will count back 20 bars and divide that price by 20. It'll give you the true average price over the past 20. An exponential moving average will add a little more weight to the front candlestick, meaning today's candlestick, so it reacts a little bit more. It's a little bit more reactionary to today's price action. If you put on a 20 simple moving average and a 20 exponential moving average on a daily chart, you're going to see very, very little difference. Okay? Now, what I like to do with the simple moving averages, I like to double them. So I'll start with a short-term moving average, which is a 20 simple moving average, double that, 40 SMA, and 80 SMA. I never read this anywhere. I just sort of started doing it one day, and it kind of stuck. Now, in a strong trend to the downside occurs when the short MA is below the medium MA moving average and the medium is below long-term MA. Strong trend to the upside, just reverse it. The short is the 20, the medium is the 40, the 80 is the long-term. In a strong trend move, in other words, in a strong, we call this a trending market condition, the moving averages will be in order, meaning short below medium, medium below long. We also have the Bollinger Bands, which is basically, that's that gray line. I made it gray and very, very thin, so it would not interfere with our moving averages. By the way, the short MA, which is 20, is green. The medium MA, which is 40, is blue. And long MA, which is 80, equals red. Just to give code key there, okay? Now the Bollinger Bands is basically the 20 simple moving average plus or minus 2 standard deviations. Now we can use the Bollinger Bands to help us find the entry, but we first have to determine if the trend is strong. So zoom in a little bit over here. Actually, let's keep it zoomed out. Daily chart, remember, same daily chart as before. Take a look to see what happened when we had a strong trending market. Remember, this, so the green was below the blue, and the blue was below the red. This started right over here. That date is May the 4th, and persisted all the way through June 28th. May 4th, June 28th. Take this away, and we'll zoom in. This is, if you can see that, that is what a strong trending market looks like, okay? In strong trending market condition, strong, and we'll say this is a downtrend, downtrending. If we want to enter a trade to sell short as close as possible to the center MA and or upper band. Okay? In a downtrending market, we want to sell short as close as possible to the center moving average, which, by the way, is a 20 simple moving average. Now, you'll notice that over here, you might say, well, hold on a second, that the Bollinger Bands don't match up exactly with the 20 simple moving average. There's a little bit of a different calculation involved. But nevertheless, moving averages, simple. Oh, I'm sorry, this is why. It should be calculated to the close. That's why they should match up. You see? It was calculated to the low. I don't know why it was like that. I don't remember doing that. But the simple moving average, which is a green line, the 20 simple moving average, should be also the green line, 20 SMA. That's the Bollinger Bands. Now, I was using a simple moving average, but the simple moving average was calculated to the low of every candlestick. I don't know why I had said it that way. Okay? No, but they're all set to simple moving average SMAs. Now, in a downtrending market, we want to sell short as close as possible to the center line, which is the 20 simple moving average. We got kind of close here. We could hit highs at 128.23, but the Bollinger Bands were up at 129. So actually, that's not so good. We have the signal possibly to sell short here. Now, we don't know. It's not always going to bounce exactly on the 20 simple moving average. Oftentimes it will. I think more times than not it will. But sometimes we're going to come all the way up to the upper band. So we have two possible trade scenarios in a strong trending market to the downside. Sell short here. In this case, there's no other way except to say that this trade probably would have been stopped out. But we were able to sell short. We hit the high of the Bollinger Bands, actually went a little bit above. At 127.50, we ended up going down to 124. But between you and me, if the market crosses above the simple moving average, it's a little bit of a warning sign to me that maybe the trend is going to end. Okay? Now that the 20 is above the 40, but the 40 is still below the 80 moving average, the moving averages are mixed, well, I'm not going to place any trades at all because it's a mixed market. It's a range-bound market. Now, it is true that there are other strategies to trade a range-bound market. We can use the Bollinger Bands to buy low, sell high, but in my experience, it's a much more difficult way to trade. The risk-reward ratios are not in our favor. There's less money to be made, and we have a less probability of making money. My advice, start with this philosophy, but only look for very strong trending markets. The moving averages are in order, and then once the moving averages are in order, we can overlay that with a trend line. Take a look at the Aussie dollar, and we'll run through both exercises here. First, we'll look at the trend lines, and then we'll overlay that with our moving averages. go back, daily chart. I like to, if I see that the market's made a big move down and big move up, I like to, zoom out so we see, in this case, we're going back to July of last year. So going back about a year, I really want to get a good idea of what the market looks like. Draw our downtrending resistance. In this case, in order to connect the 3 points, we have to intersect this line a little bit. That's okay. Uptrending support level, that's okay too. Now, long-term triangle consolidation pattern. Remember, within every range there's a trend, and with every trend there's a smaller range. So this is a long-term, very long-term trend, range-bound triangle consolidation pattern. Within this triangle, there's a smaller trend. Zoom in. This is the trend. Draw our support level, and we might draw the trend lines a few times, and that will show us that, well, the support level did hold quite well until it eventually broke. Now we're going to look for a support line that still does hold water. We cannot draw the trend line like this to connect to today's lows because today's lows are not confirmed. We need to see two prior lows in order to guesstimate where the new level might be, the new uptrending support might be. Okay? So in this case, I'm going to leave the trend lines just as they sit. That's even worse, okay? I'll take that away. See if we can find a parallel line that tends to agree with the trend, and we have one here. Not too bad at all. That's a very nice, consistent trend line. So the fact of the matter is we have a very long-term, range-bound pattern. Within that pattern, we have a shorter-term trend, but that trend, how many candlesticks, how much does the market need to break below the support in order to tell us that support is broken and the uptrend is broken? If you ask 3 traders, you're going to get 3 different answers. Technical analysis is a little bit of an art, a little bit of a science. The fact of the matter is, it really, you know, it is. We have to make a rule for ourselves and make to follow the rule. I, for the longest amount of time, have used 3. I just like the number 3 for some reason. 3 moving averages, 3 candlesticks. If I see 3 candlesticks that close below a support, in my mind, that support's broken. One line, and to make no mistake, we're talking about closing levels here, not the long candlestick wick, but this candlestick actually did close below the low. It's enough for me. If we see, and this will only, you only get a better idea how to use this with time. But we see a few consecutive red candlesticks that close, especially closing near the low of the candlestick, which means there's not a long candlestick at the bottom. This tells me the support level is broken. I would not buy the Aussie dollar here under any circumstances. Now, plug in our template with moving averages and Bollinger Bands, and we see what happens over here. The green line, 20 simple moving average, is still above the 40, and the 40 is still above the 80. So according to the moving averages, we're still at an uptrending support level. But notice what has happened. And again, we have to adjust these lines, again, to close. I'm going to resave this template here. Not low. Close. Save template as MA's and Bollinger Bands. Yes, replace it. Okay. So notice what happened over here. Okay. Our trend lines disappeared. I'll redraw them. When this trend line, this uptrend was confirmed, which was over here, the 20 was above the 40 above the 80. And I said to myself, I want to buy at the 20 simple moving average. I had the opportunity to buy over here. I might have gotten stopped out, maybe not. But it ended up going up quite a bit more. Notice it did hold at the 40. There's no match at one moving average or another. But it did approximately hold. On a daily chart, how much of a spillover can we imagine? Well, the moving average was at 102.70. We went down to lows of 101.70. 101.70, 102.70. Is that right? 102.60. It went down about 90 pips below supports, 90 pips below the moving average. Throw in the ATR, average true range. What was the ATR at that point when we had placed that trade? The ATR is 0.0093. Have a look at that. Imagine how that works. The ATR, the market went down almost exactly one ATR. On a daily chart, one ATR is 93 pips, Aussie dollar. The market went down about 90 pips below that moving average. If you had entered exactly at that moving average, and if you had used exactly a one daily ATR, you might have been stopped out, or if you were not stopped out by 3 pips. This was considered a very big, this was considered a very big spillover. This is not the type of spillover I would anticipate most of the time. This spillover over here. That's a violent move down. Most of the time you're not going to see the case. The Aussie dollar, like the Euro dollar, for some reason the dollar crosses, they don't seem to be very, very trendy right now. And as a result, you see these big spillovers above and below the moving averages. Aussie trendline breach could be a fake out and get back in. Depends what Bernanke did this Friday. Yeah, of course. I mean, I'll be, you know me, I love to overlay all this with fundamental analysis. But just from a technical point of view, we could, look, it's a dangerous thing to justify and to say, well, it could be because of the Federal Reserve, or it could be because of summer trading in August. All of that could be the case, but we have to establish a set of rules and to say, you know what, we drew this trend line like this, and it closed 3 candlesticks below the trend line, and my personal rule is if it closes 3 candlesticks below the trend line, then it's no good to me. And in my book, this Aussie dollar, I would not buy the Aussie dollar. In my book, this means that we're probably, the moving average is eventually going to cross over, and this is going to be the beginning of a big reversal, in my mind. When I say that, I'm also, I'm thinking of all the fundamentals between the Aussie and the dollar, and which both have, relatively the same fundamentals, stronger than others, but nevertheless, I'm thinking of the correlation stock market. I'm thinking of what I think Bernanke is going to say. I'm thinking of what I think the market reaction will be, and I'm thinking the Aussie dollar goes down. So, that's why, by the way, I always love to say this, that the best trader or a good trader is better than the best computer program that we could ever imagine. Computer programs, auto trading systems are only as good as the person that codes it. And the fact of the matter is that when I look at a chart, like this Euro-Aussie chart, I'm thinking of so many different things at the same time, as well as I'm trying to make a note of the market's reaction to news, whether the market's ignoring the good news and focusing on the bad news or vice versa. So, and I so far have not been able to code any type of auto trading system that encompasses all that. The human mind is a very powerful computer. Take a look at the Euro-Aussie. Let's first throw in, well, we know what the trend line is going to look like. It's going to look very, very smooth and consistent. Draw a downtrending trend line as follows, and that's just a beautiful thing. And obviously we know the point that the market closed 3 candlesticks above, that was over here. 1, 2, 3. 3 solid candlesticks, August 15th. As far as the Aussie dollar, I'm not going to do anything at all with the Aussie dollar. Not until a new trend emerges. My best guess is that the Aussie dollar's new trend will be to the downside, but I'm not going to, look, to be honest, in my own account, I might throw on a small short trade just to try to, get a good price. But I'm not going to try to build any massive type of position in the Aussie dollar until it develops a strong trend to the downside. We're going to have plenty of time. If what I think happens, happens. Throw in our template over here, 3 moving averages, which is over here. And the Bollinger Bands, 20 is above the 40, 20 is above. 20 is below the 40, 40 is below the 80. That strong trend to the downside really was solidified here. Notice the moving averages are not going to help us find the top or the bottom. They're only going to kick in when the trend is really solid. In this case, the market had such a strong trend, if we chose to sell a short near the 20 simple moving average, we might not even have had a chance to do so. There's nothing wrong with throwing another moving average, a 10 moving average. I like to use doubles. So half of 20 is 10. And we'll make this even a different color. We'll make this green, blue, and red we have yellow. Okay. The shorter the moving average, the more directional the trend. In this case, the Euro-Aussie trend was so strong, we would not have been able to sell short near the 20 simple moving average. The 10 moving average, the 10 simple moving average would have been the best place to sell short. By the way, I didn't type this in before. In a strong directional trending market condition, take profits near the Bollinger Bands and or trailing stop. Where is the trailing stop? Trailing stops should be placed above the last moving average that worked, meaning 10 simple moving average seems to be working right now to sell short. We could have sold short here. This was on June 29th. Sold short again here on July 13th. Sold short again here on July 27th. And again here. Our stops have to be placed at a logical point in the chart where we do not expect the market to break above. So if the 10 simple moving average seems to be working, place the stops on above the 10 simple moving average. Maybe you'll use a 20 simple moving average. We can take partial profits near the lower Bollinger Band. There's a number of different combinations that we can do, that we can use. The Euro-Aussie was such a strong trending directional market. Let's zoom out here a little bit and draw our resistance line as follows, which is over here. We'll make this nice and dark. Zoom in. Okay, I know it's really tough. We're starting to have a lot of different lines here. But the white line, if you can see that, is our resistance. That white line, that trend line, at one point falls almost exactly on the simple moving average. It should, because we're connecting the same highs. But eventually, notice the simple moving average did a better job of hugging the market, representing new resistance, and eventually telling us when the market changed course. In fact, the market changed course when it crossed above the simple moving average at the same time that it crossed above the downtrending resistance and the simple moving average. And you're right, the moving averages do lag to an extent. The 10 simple moving average did not cross above the 20 until we got to, well, just about here, August 20th. We crossed above that trend line a few days prior. I'm not suggesting we use trend lines or moving averages. I suggest we use everything. I think we should use both. Use the trend lines and moving averages to quantify the trend and to project where future support and resistance might be. When you find levels in a chart that everything tends to agree, that makes even more sense in the world. Let me think. There was another market. There's a few other currency pairs. Pound Aussie. Erase everything here. Let's go to our moving averages. Template, load, 3 moving averages. Okay? In this case, the 10 closed below the 20 and the 20 below the 80. 20 below 40, 40 below 80. Over here. Over here is July 5th. Notice in this case, and this is why I rarely use a 10 simple moving average. If you use a 10 simple moving average like this, we would have gotten stopped out. Usually the 10 simple moving average is too close. In the Euro-Aussie chart, the previous chart we looked at, the trend was so severe, it was so significant that it was not the case. I hate to generalize, but if I had to pick one moving average that I think does a really good job of representing support and resistance, I would say the 20 SMA, which also is, by the way, what the Bollinger Bands use. So you might only want to use the Bollinger Bands, but I think using the moving averages help really quantify a point on the chart when the trend is very, very significant. Over here, let's take away the 10. So the 20 simple moving average, the moving average is at 152.94. We hit highs 152.86. 8 pips difference. On a daily chart, that's huge. Here, moving average 151.60. We hit a high of 152.20, which is what, 60 plus 60, 60 pips, right? Insert the ATR, average true range. What was the ATR at that point? 93 pips. You see how that works? I'm using a 1, actually it was more than 93 pips. It was actually 100 pips, exactly. If we had used a 1 daily ATR on a daily chart, which is 90 pips, and we sold short exactly on the moving average, the market went up 60 pips above the moving average. We would not have been stopped out. We would not have been stopped out here. And from our entry, which is the moving average at 152.90, we came down to the lower Bollinger Band, which is 150.17. 152.90 down to 150.20, let's say 150.30, 260 pips. It went down 260 pips using a 90 pip stop, which is 98, which is the ATR. Risk 90, we make 260. Realistically, 3-to-1 risk reward ratio, 3 times 9, 27, just about, almost exactly 3-to-1. We sold short here. We use a 90 pip stop, which is 1 daily ATR. It went up 60 pips. We would not have been stopped out. We came down. The simple moving average, remember, we sold short 150.160. The lower Bollinger Band, 150. 150.160, 150.30. It went down 130 pips. Maybe we would have taken partial profit and left our trailing stop 1 ATR above the simple moving average. It's a very, very simple idea that we can implement. We would have been able to trail this all the way down to 147, and eventually, well, the moving average of 149.26 plus 1 ATR, which is 90, 150.16, let's say 150. We sold short here at 150.175. We made another 175 pips on the second half of the trade. Not too bad. And eventually, well, we see here, this is when the moving average were to will eventually cross over. Technically, by the book, we're still in a downtrend on the pound Aussie. But remember, we use our trend lines as well. The trend lines will be able to tell us when to get out of the trade faster than the moving averages. This would have told us to get out. 3 candlesticks closed above resistance, almost exactly on a 20 simple moving average, 149, closed the entire position. Sell short here, well, actually at this point, sell short here, that was on July 16th, at a price of 153. Take partial profits, trailing stop 1 daily ATR above the moving average. Sell short at another point here, trailing stop, one daily ATR above the moving average, take partial profit. Trailing stop would have kept us in all the way to the trend line. When we see the market crosses above the trend line, close the entire trade. You close the entire trade at 150. We started entering this trade almost at 153. And this is just one currency pair, one little piece of the trade. We have a lot of currency pairs and a lot of different trades. I really don't have a lot of time left, so let me see if I miss any questions. The earlier signals that change of slope. Yeah, that's why I like to, again, that's why I like to use the combination of trend lines and moving averages. the moving averages lag. So it's gonna take longer for the moving averages. It's gonna take more confirmation for the moving averages to tell us to get into a trade. That's okay. Most traders, I think, place too many trades. So it's good to use an extra filter and tell us when not to trade. When I'm placing a trade, that should only represent the top 5 or 10% of all my ideas. In this case, with the pound Aussie, the trend line made sense, the moving averages made sense, everything made sense. This is a good time to place a trade. Now, the trend line will get us out of the trade faster because it tells us sooner when the trend is over. But in my mind, if the market is still below its trend line and the moving averages are still in order and we have not hit our stop level, which is one daily ATR and a daily chart, in my mind, the trend is still good. And the fact of the matter is, well, the pound Aussie, we had a trend for about a month or so. We looked at the Euro Aussie. We had a trend. This is about 2 months or so. Well, actually about 1 month or so. But, not too long ago, we saw trends. I don't know. Here's a daily Aussie yen. Throw in the template over here. Load the template. Okay. The moving averages first fell into order over here, May 2nd. The trend line told us to stay in this trend until here. And actually a steeper trend line would have gotten us out of the trade earlier if we drew the trend line as follows. But take a look at the power of this trend following system. We would have first decided to sell short at 83.50. The market ended up going down to 74.45. 83 to 74, 900 pips. 900 pips from May the 2nd. We hit lows May 31st. In 1 month, 900 pips. Now, I'm not saying that we're going to be able to catch the top and the bottom here. No way. But if we see a market that all of a sudden develops a very, very strong trend, it has the potential to move 1,000 pips a month, or maybe 1,000 pips in a couple days. Once we're in the trade, pro-trend, who knows how much the market can go. Once we're in a trade and the stop order is behind us, and we don't really run any risk of touching the stop order unless something really, really big happens, I don't like to use fixed limit orders, especially on long-term trading positions, because who knows how long it can last. Apple Computer went from $50 a share to 100, then 200, and 300, and people said 300, this is it can't go anymore. We're at 675 now. When the trend is your friend and the market picks a direction, especially in the Forex market because of the underlying fundamental reasons, once the Aussie yen decides I'm going up or I'm going down, don't get in the way. Who knows how long it can last? Remember the days of the financial crisis. Go to a weekly chart. The Aussie yen, at one point we were highs of 108. We went down to 58. That's 5,000 pips. If we had some sort of position on the Aussie yen and we sold short maybe at 100, who knows how long, how much of this big move we could have gotten. But the beauty is with the strategy, look, I know it's daily charts and we're talking about long-term trading and most likely short-term trade, but we can use this as short-term trade. It tells us when to get in, when to get out according to different moving averages, and we can scalp on these moving averages all day long. But it's going to prevent us from getting into trades that we should not get involved in. It's going to prevent us from buying the Aussie yen after it's already crossed below its moving average or its trend line, or it's prevent us from buying the Aussie yen if the moving averages are mixed. And I think that's the most important aspect of the strategy, is not that the trades it's going to find, it's the times it's going to tell us, no, don't do anything, because we don't have all our ducks in a row, and it's a high-risk situation. That's what I think a good strategy does. Not only tells us when to get in, but it highlights the times that we should not get in. Now, fortunately, I'm out of time. If you want to contact me directly, please feel free to do so, www.forexlounge.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see the calendar because we have a lot more ahead of us. Again, We thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back. Back in time.